Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to this special edition of InvesTips from the CIO's desk. My name is Steve Brice and I'm Standard Chartered Bank's Global Chief Investment Officer. Today I want to talk about how to manage market volatility. We've seen significant volatility since Trump announced widespread, sizable tariffs on exports to the US. Now, I'm not going to go into our latest thinking on what all this means for different asset classes. If you want that, please listen to the weekly Through the Noise or daily Cut to the Chase podcast series. What I want to do today is emphasize how important periods like this are to investors' long-term performance. I truly believe the decisions you make in the coming days and weeks will significantly influence your long-term financial outcomes. Therefore, I want to give you some tips on how to manage yourself to achieve better outcomes over the longer term. Let's start with some facts first. We know that the volatility seen since Wednesday's announcement has been severe. US stocks have led the move lower, down over 10% in the past 2 trading days. This clearly unsettles a lot of investors, and this risks you taking actions today that might make you feel better now, but will be extremely damaging to your long-term financial goals. Therefore, it's important to remind yourself: 1. Volatility is a normal state of affairs for markets. 2. We're all human beings and we all face different behavioural biases. 3. The longer you hold investments, especially investments diversified across asset classes and geographies, the more likely they are to generate positive returns. 4. Buying after periods of market weakness generally improves forward-looking returns. And 5. On average, investors underperform because they sell after market weakness and buy after market strength. Morningstar places this underperformance at an annual 1.1%, which doesn't sound big, but if you compound this over 20 to 30 years, the impact is huge. Okay, so what can you do about this? Well, the first step is to understand yourself. Now, if you're like me, you get excited about markets going on sale. And to be honest, I'm a little less worried about you. Although it is important to remember that there are risks inherent in any investment, and it's important not to be too narrow in your investments. The risk for you is overconfidence. However, the majority of investors I talk to get scared when their portfolios fall in value. If you fall into this category, then the following advice is critical. First, make sure your investments are diversified. The same Morningstar research referenced earlier shows that the return for investors in multi-asset diversified funds track the performance of the underlying fund much more closely than for funds with much narrower exposures, such as equity sector funds. The reason? The volatility is lower. Therefore, you're less likely to get scared and make decisions that you will later regret. Second, remind yourself, this too shall pass. The more diversified you are, the more likely it is that losses will be temporary. For instance, analysis since 1950 shows that the range of 1-year returns for a portfolio which is allocated to 60% of stocks and 40% of bonds, the range of performance for 1 year is minus 16% to plus 32%. However, over 5 years, the range shifts to plus 1% to plus 20% per year. And for 20 years, it's plus 5% to plus 14% per year. So you can see the longer time horizon you get, that bottom number goes up and goes into positive numbers even within 5 years. Therefore, third, staying invested and adding to or even accelerating investments into falling markets is the optimal long-term strategy. So what are some of the tricks of the trade? First, have some cash on the sidelines. Now, theoretically, this is suboptimal. Any statistical model will say you're better off being fully invested. However, we're not rational human beings, and having cash on the sidelines can help you think in terms of markets going on sale, so that not only do you not sell existing holdings, but you also buy items on sale. It can also, of course, help you sleep at night. Second, Set up a default level of investments every month and accelerate into weakness if you can. Third, understand where you want to increase exposures and look for opportunities to add to that part of your portfolio. For instance, if you have a lower allocation to equities than you want to have, then prioritize these investments if equities weaken significantly. Finally, if you find that your investment rollercoaster ride is too extreme for your taste, don't panic. Just recognize it and have a plan to reduce your exposure gradually to more volatile areas of the market. Don't throw out the baby with the bathwater. Also learn from it to ensure that you cap your exposure in the future so you don't have to learn the same lesson over and over again. Now, a final note before I sign off. I guess in the relative serenity of a podcast, what I've taken you through is hopefully easily understood and something that sounds easy to follow. Unfortunately, we live in an extremely noisy world, which makes it much harder to stick with the plan. It's easy to get knocked off track by the negative news we're being bombarded with. So when you feel the need to sell out of your diversified investments, breathe. Remember, this too shall pass. The human race has time and again proven its ability to deal with crises and come out stronger. Therefore, think about what your future self would thank you for. This will hopefully guide you through market volatility and help you achieve your financial goals. I hope you found this podcast useful. Please feel free to look out for other educational content in the InvesTips or InvesTips from the CIO's Desk series, and I look forward to talking to you again soon. Take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.